The majority of the S&P 500 over the last week has been hammered. We have the likes of Nvidia down more than 16%, as well as other industries, although the main focus today is going to be on the semiconductor space, where we see a lot of negativity throughout, and we're going to talk about the increasing investigation and antitrust, in fact, into Nvidia, what it means for this company moving forwards, why in fact it is down based on these reports. We're also going to take a look at a very well-known and popular analyst, Tom Lee, who has discussed we could be in for a 10% drop overall, in fact, over the next 8 weeks. And we're going to take a look at 6 semiconductor companies, including Nvidia. We're going to talk about each one's performance, how they've been over the last few years. We're going to talk about how they've performed in their earnings, what the expectations are moving forwards, as well as a quick deep dive into some of their financial metrics, including their free cash flow, their sales growth, and ultimately we will conclude on each one of these 6 in the valuation side. What is ultimately our own intrinsic value for these companies? What do Wall Street forecast moving forwards in terms of their numbers, the upsides, as well as what our margin of safety is, and whether or not we believe each one of these 6 are a great opportunity, great time to buy, maybe even dollar cost average, or for some of these, whether we should actually wait for a larger drop if in fact we do see one coming. So the first thing that we do want to mention today is that when we look at the fear and greed index, something that does tell us a lot about the market sentiment, that we are currently sitting in the neutral space, which interestingly, as we are about to show you, the market can change very quickly. Just 1 month ago, we were sitting in fear. A week ago, we were in greed. In fact, the previous close was sitting at greed. So now we have recently moved into the neutral space. Now, whilst this shouldn't dictate whether or not you invest in companies that you do believe to be undervalued, it just goes to show us the overall sentiment of how the market is feeling. And right now, it is sitting in neutral, which means investors aren't too sure which way the market is going to go. And therefore, just something to bear in mind when you do look at companies like we are going to in today's episode. As we did mention, Tom Lee, who is in fact a very bullish forecaster over the more recent period, has been nailing a lot of his calls this year, and he in fact mentioned that we could be in for a drop of 10%. Now, the reason why he in fact states the next 8 weeks, there is a lot going on, especially in the US, and in fact what he has said is that the market has been up for 7 of the 8 months this year, and therefore we are sitting in now a very strong, very bullish market. However, we have a lot of things that are up and coming over the next few months. The first one being the September rate cuts, which the whole market has now priced in, very confident that we will see this. And the second, if not even more important thing, that does bring a lot of nervousness, a lot of ambiguity to the market, is in fact that the election is only months away, and this is at the time where people and investors do get incredibly cautious about what moves to make in the market. The S&P 500 over the last 10 years does show us that September is the worst performing month that we have just entered, down 2.3%. As we can see, the remaining 11 months showing positivity, but it doesn't just stop there in terms of the data. And in fact, for those that did read our latest free weekly article, we talked about how the S&P 500 underperforms leading into a US presidential election. And over the last 6 elections, which is quite some significant data, it has in fact averaged a negative 4.3% over the 2 months. Now, that is pretty much where we are sitting now. So not just the presidential data, but also, as we just talked about, on a monthly basis, September doesn't look to be one of the greatest periods for the entire market. Just something to bear in mind, but as always, when we do invest, we like to look at the companies on an individuality basis. Now, moving on to the first company, it is Nvidia, and interestingly, we have noted in their latest earnings, which was just last week, they had some very large growth, in fact 122%, which they determined a lot of this was for the increasing demand that they are ultimately seeing from their data center. And for those that do watch our in-depth deep dives of this company, no surprises, as this is one of the areas in their revenue, if not ultimately their key driver, which is propelling their top line further and further year on year. And we do also notice from, in fact, this earnings, they did beat on both the EPS as well as the revenue. So it was very good earnings. However, one thing that is very interesting to note, just yesterday, after the very poor performances across the market and in fact semiconductors, Nvidia had 279 billion wipeout, and as we can see, that is from the market cap and ultimately the biggest in US history, which did in fact drag down all of the global chip stocks that we are about to look at today and understand if we should be executing on this drop. Now, one of the things that we do want to talk about as well, the reason why in fact we did see this, is that Bloomberg did report the company has received a subpoena from the Department of Justice, the DOJ, as part of an antitrust investigation. Now, when we look at this into the detail, we can see the reason for this is because right now Nvidia are a dominant AI hardware player. In fact, they are the #1 leading in this market, and the ultimate reason for this, as we can see that Bloomberg did report, is that Nvidia as well as other companies have received what is a legally binding request, so they need to uphold to this for information, as the regulators are investigating whether or not Nvidia is making it harder to switch to other suppliers, and in fact penalizing any buyers that don't exclusively buy their AI chips. So now that is something that has taken the market by a bit of a surprise. It wasn't already something that was known, hence why we did see that large drop, not just to Nvidia but also across the market, and that is something we are going to analyze today, whether or not in fact we have an incredible opportunity to add to some very large names. Now, before we jump straight into the analysis, we do also want to remind you that from Bloomberg just last year, they did talk about how AI is going to become a 1.3 trillion market by 2032, so not that far at all, and they ultimately believe this industry is going to grow at 42% year on year over the next 10 years. And interestingly, over the last few days, we have seen tweets from Elon Musk, who has been talking about robotics coming into the world very, very soon. So now let's get into the detail of these 6 companies. Now, the first one is going to be Nvidia in today's episode. As we can see, as always, Wall Street have given this company a strong buy, although we know both Seeking Alpha and Quant have given this a hold. It is trading in the mid to upper end of the 52-week range. It does have a yield, although very trivial at 0.04%, but we will still mention it. And the forward PE currently sits at 38. Again, S&P right now sitting around 22.5. Now, in terms of the performance, over the last year, it is up around 122%, although over the last week, it is down around 10%. And if you've been a long-term shareholder, well, over the last 10 years, you would be a very, very happy person, up more than 22,000%. Now, when we take a look at their latest earnings in terms of the numerics, what we do note, over the last 4 quarters, they have beaten, so that is a very good record, 100%. And in fact, over the next 4 quarters, they are anticipating double-digit growth to the EPS, so very strong. And if they ultimately hit their January 2026 3.9 EPS estimate, the forward PE will come down to around 27.12, making it a lot more attractive perhaps than the current valuation. So let's get into some of the details, the metrics. Now, every company we will talk about the dividend safety. However, for Nvidia, a little bit less relevant. As we said, the yield, very, very trivial. They currently have an 89 very safe score, and their market cap does sit incredibly high at 2.65 trillion. It could very well soon take over as the #1 most valued company. Now, for those that are interested to know, the dividend safety score was reaffirmed just a few months ago, and what this means is that a dividend cut is highly unlikely. For each company, we're going to look at some recessionary metrics, how they performed in the great 07-09 recession. Now, they paid no dividend, so no comparison. They had negative 35% recession sales, which was below the average growth of the S&P at negative 12, and they also trailed the S&P negative 78 when itself came in at negative 55. Now, dividend growth, not something you think about when we talk about Nvidia. However, they did increase that dividend at 150%, so triple digit just this year. Over the last 5 years, 1%. In fact, they did maintain it for quite some period. Over the last 10 years, in fact, we do see 7% year on year. And they've only been increasing that dividend for 1 year now, given that increase for this year, although they have been paying a dividend without a reduction for the last 11. For each company, we do like to focus on dividend yield theory, which tells us a company is undervalued when the current yield sits above the 5-year average. However, for Nvidia, very low yield ultimately, so it isn't something we'll discuss for this company. We'll draw your attention to the forward PE. Now, it sits at 32.5, which is lower than the 5-year average, so this in fact is an undervaluation signal. However, when we do look at the information technology as a sector, it does sit lower. But as always, within this, in fact, sector P, there are a lot of low quality companies. And ultimately, do remember, we don't focus on any of these models, and we do conclude when we run it through the valuation towards the end. Now, free cash flow, we'll just talk about this very briefly. They do pay a dividend very low. We want to see below 50% for the industry, 1% in 24, 1% over the next 12 months. So ultimately, if they really wanted to, they could continue to increase that dividend at a triple-digit rate. Now we get on to the more important metrics for Nvidia, the free cash flow per share. We want to see consistent increases over the longer term. Now we do see increases, although the large increases have just come over the last few years, and we can see over the next 12 months, this is expected to more than double to around 294. Then we get to the sales growth. No surprise if you have been following this company. Whilst for more mature companies, we want to see 3 to 7%. For the likes of Nvidia, a lot more, especially as they are growing. As we mentioned as well, this AI industry is expected to increase around 40 to 50% year on year. 2024 triple digits, over the last 12 months triple digit as well. And when we do look at it from a numerical standpoint, we can see just under 5 billion to around 61 in 2024. Now we'll also quickly mention the shares outstanding. What we'd love to see from companies are those that do share buybacks, returning excess cash. However, what we note, they would have diluted your position over the last 10 years. But ultimately, do remember the share price has increased significantly over this period, so you probably wouldn't care too much about this. And it is something they are looking to do in terms of share buybacks. With their latest earnings, they did just announce a 50 billion share buyback program. ROIC as well, one of our favorite metrics. We want to see 10% or more, or in fact 12 for semiconductors. Give us faith, management are able to effectively allocate their capital. Above that every single year consistently, 61 in 24, 87 on a trailing 12-month basis. That does look very, very strong and does make it incredibly attractive for investors to consider. Now, when we look at the margins, there are some things that we want to see. Firstly, above 16% for the industry, but also increasing over the longer term. Something that we see for Nvidia, so that is what we would ultimately call operating efficiency. We don't just want companies that increase top line, but also the margins, as we can clearly see. And the free cash flow margin year on year looking well above the minimums, a free cash flow machine, something we really like to see from companies. And then we get to the final metric, the net debt to EBITDA, referring to the earnings before the interest, tax, depreciation, amortization. Below 1.5 is what we want to see. Remember, this correlates to the dividend safety, balance sheet strength, and these numbers below show us the number of years it would take the company to pay off all of their debt net of cash on hand. Not even one day over the last 10 years, not even one day for them to pay it all off over the next 12 months. Very strong balance sheet, and the dividend also does look to be secure. So let's jump into the valuation for Nvidia. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, our intrinsic value of $140 for Nvidia today has come from the DCF model. Now, we're not going to run through each model for each company. We'll just show you how we do it for this company today. Now, we have the free cash flow growth year on year. Over the last 5 years, 135% year on year. Over the last 10 years, 94%. Now, today's episode, we have gone for 30%. As you can see, though, we have a low, medium, and high rate. Based on the 30%, with the discount rate, we get the present value of future free cash flows and terminal value. We add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and there is that price. Now, that ultimately gives us 31% upside, but for those that believe that is in fact way too high, well, just for transparency, the 25% rate would give a $101 value. As we can see, downside of 6%, 35% as we can show you as well for those that believe that is a better rate, $192, ultimately 80% upside. Remember, these numbers are subjective, but if you want, you can grab a copy of this model in the pinned comment below, running through your own numbers, whether that's for Nvidia or any other company. And for those that want to see the 42% that Bloomberg do discuss at the beginning of this episode, when we do put it in, we get an intrinsic value of $296, meaning that is a 177% upside. Now, as we said, we will take through the median rate of 30% today, and what this ultimately means, we will put it through the margin of safety as well. So with the current price after the drop of around $107, we always like to add a margin of safety starting at 10%, which we execute on if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that, we'll buy up to $126, then we keep going till it's near the current trading price. And what we can see in today's episode after the drop, you are ultimately getting near a 25% MOS at $105, but right now sitting somewhere between the 20 to 25% level. We also know Wall Street are very bullish and they see upside of 42% currently with a price target of $152. As always, as we go along this episode today, do let us know your thoughts in the comments below for each one of these companies. Now, before we continue, just to let you know, we have released our latest free weekly article where we run through 3 undervalued dividend stocks. If you want to grab a copy of this or any others completely free, instant access, do click on the pinned comment below, and you can also get what we have newly released, our undervalued stocks for the month of September. We have 25 where we have gone through each one in quite some detail, as well as detailing which ones sit within our portfolio, so do check that out by clicking below. So the next stock we are looking at is ASML. Now we have a double buy rating and a hold from Quant. This one now trades in the mid to lower end of the 52-week range. It has a forward P sitting around 40, and we also note the yield of around 0.8%. When we look over the last year, it is up around 27%. Just over the last week, though, similar to the industry, down around 9%. And if you've been a long-term shareholder, you would be up around 755%. Now, when we take a look at their earnings, how they've performed, well, again, very similar to Nvidia. They have beaten over the last 4 quarters. When we move forwards as well, just the next quarter in the mid-single digit increase expected. However, the subsequent 3, they are anticipating some very large growth, in fact, double digit and triple digit, which ultimately, if they hit their next year full year EPS, that will bring the forward PE very quickly down to around 25.62. Now, similar to Nvidia, we're going to talk about the dividend safety, although again fairly trivial, an 82, very safe score. Market cap, though, significantly lower at 340 billion. Then in terms of the recessionary metrics, well, they cut the dividend. They had below average growth at negative 56%, although they pretty much had the exact recession return of the S&P at negative 55%. And whilst they had a very mediocre increase to their dividend in July at 4.8%, remember on this channel a minimum of 4% just to keep up in line with inflation, we note over the last 5 and the last 10 years, ASML have been increasing that dividend very rapidly at the double-digit rate. And we do also note 14 years of consecutive increases. Now, in terms of dividend yield theory, we actually get a double undervaluation signal for ASML, something we haven't seen in a little while, both on the yield 0.82 above the 5-year, as well as the forward P 29.5 below the 5-year 34.2. We do, however, note it is still higher than the information technology sector as a whole. Now, when we get to the free cash flow payout, it has been below 50% every single year, bar 2023, so no surprises where we saw that lower increase. And we do note over the next 12 months coming all the way down. So we would like to see in 2025 a strong double-digit dividend increase, something we have seen with ASML over the longer term. Then we get to the free cash flow. One thing we haven't discussed today so far is that the industry for semiconductors as a whole is fairly cyclical. So we will see this in some of the numbers in these companies today. We note that over the longer term, whilst it has increased, it has come down in 2021 from the highs to 2023 to 8.25. But moving forwards, 20.6, large growth is anticipated, and they do tend to have a very large backlog as well. Then we get to the sales growth. Now, we do note a lot of inconsistency. Nonetheless, very, very good. Just in the more recent year, we saw 30% increase to their top line. And when we do look at it from a numerical standpoint, well, we can see that growth 6 billion to 28 in 2023. On top of that, what they've also done is return excess cash to investor pockets through those share buybacks over the longer term, buying back roughly around 10% shares over the last 10 years. ROIC as well looking very, very good, very healthy. Last 3 years looking incredible as well in the mid to upper end of the 40%. So again, this is something that we very much like to see for companies we are considering. And in terms of the operating margin as well, not just above the minimum 16%, but operating efficiencies as we see the increase. And again, no worries whatsoever on the free cash flow margin. Then we get to the net debt to EBITDA, something to spot very similar to Nvidia. Not even 1 day to pay off all of their debt, net of cash on hand, a very, very good balance sheet. Now, our intrinsic value today at 1152 is marginally lower than Wall Street's forecast. They have 43% upside. Again, these semiconductors right now showing us it could be a good time to consider for the portfolio. And a 10% MOS, a buy at 1036, at 15% around 979. And we can see in today's episode, you are getting, in fact, at least a 25% MOS at 864 At 30%, you would need to wait around $806. So that is pretty good for what we would consider to be one of the best high quality companies in the industry. So for a quick conclusion, 25% margin of safety with 43% upside. We then move on to Broadcom with a double buy and a hold from Quant. This one trades in the mid to upper end of the 52-week range with a yield of 1.37%, a forward P of 32. Now over the last year, still very good performance, up 75%. Just over the last week though, it is down around 6%. And over the last 10 years, again, one of the best semiconductors in the space, up 1,639%. Now again, we are seeing a very good theme here with these incredibly high quality semiconductors. They have beaten over the last 4 quarters, and over the next 4, again, double-digit increases expected to EPS, with the forward P coming to around 25 by October 2025, again, if, as we expect, they do hit those targets. Then in terms of dividend safety, a little bit lower than the previous 2 at 67 safe, and the market cap does sit around 711 billion. In the last recession as well, we did see they had around average growth at negative 12%, and one of the things we love about this company, not just the share price return, but also that dividend increase, very consistent, double digit every year, 36% in fact over the last 10 years, and they have been increasing those dividends for the last 13 years. Now, in terms of dividend yield theory, we do get an overvaluation signal. That yield is a lot lower than the 5-year average, as well as the forward P does sit higher. And when we compare it again, no surprises, whilst it does sit in fact higher than the information technology, it is the lowest that we have seen so far in today's episode. Then we get to the free cash flow payout, below 50% every single year, so no complaints whatsoever, especially given they do increase this dividend at a double-digit rate. And the free cash flow per share, pretty much one of the ideal models that we want to see for companies that we invest in, increasing consistently over the last 10 years and anticipated with a nice increase over the next 12 months as well. Then we get to the sales growth. Whilst we do see again that theme of inconsistency in the industry as a whole, we do note their numbers as a generalization have performed very, very well. In fact, you can clearly see that when looking at it from a numerical perspective. One thing that is very common and we have seen in this industry, they will dilute your position over the longer term. But again, to be honest, you wouldn't really care when you are getting returns over the last 10 years of over 1,000%. Then we get to the ROIC. Maybe for Broadcom, we do start to see the inconsistency of the industry as a whole play out more in their numbers, dissimilar to the previous 2, Nvidia and ASML. Nonetheless though, ROIC at 26% over the last 4 years does look very good. And we do also note that essential operating efficiency over the longer term, but again, we do get an inconsistent basis on a year-on-year. Free cash flow margin though, absolutely gorgeous, been increasing over the longer term. In fact, just over the last 4 years, very consistently at the 50% level. And when we get to the net debt to EBITDA, unlike the previous 2 where they were 0 across the board, we do note this does have a fairly large number, 1.1 in 2023, which is positive. It has been decreasing from the very high 2.5 in 2020, but we do want to point out over the next 12 months, it is anticipated to increase to 1.85, which is why we do get the lower dividend safety score and ultimately not as good of a balance sheet as both Nvidia and ASML. Nonetheless, when we do jump into the intrinsic value at 165, 2 things to note here. Our value is much lower than Wall Street. They see 30% upside at 197. And the second thing, when we do run it through the MOS, it will be lower than the previous 2. In fact, if you want a 10% margin of safety on Broadcom, we don't quite see that yet. You may not have to wait too long. We see that around the 149 level. So whilst we would say that Nvidia and ASML do look like very good companies to consider, even just dollar cost averaging in, Broadcom, if you want a larger MOS, may be one that you need to wait just a little bit longer. We then move on to Micron Technology, where we get a double strong buy. First time we've seen this today with a buy from Seeking Alpha. This one is trading in the mid to lower end of the 52-week range. Again, another trivial yield, something we see in this space. 0.52% and a forward P, as we will mention with essentially their earnings, this will come down. Over the last year, up around 26%. Over the last 5 days, down 8%. And we do note over the last 10 years, up 181%, keeping up the theme that so far these stocks have outperformed the S&P over the last 10 years. When we do look over the last 4 quarters, they have in fact beaten analyst targets, and the forward P will come down from 9.41 when in fact August 2025 they are able to hit that EPS 9.41. Then we talk about the dividend safety. Well, it sits at 60, borderline safe, and we are still waiting for a recent dividend growth increase. Market cap, one of the lowest ones in today's episode at 98 billion. Then what this ultimately means for those that are interested, the dividend safety score, a borderline safe, suggests a moderate risk of a dividend cut over a full economic cycle. We also note in the last recession they did have below average growth at negative 18%, and as we said, we are still waiting for an increase. It has been a while, but over the longer term they have been increasing the dividend for 2 years whilst paying a dividend without a reduction for also the last 2. In terms of dividend yield theory then, we do get that undervaluation signal, although marginal. In fact, you could argue reasonable valuation, 0.52 above the 5-year average, although the forward P, as we can see here, adjusted at 12.3, does sit higher than the 5-year rolling, as well as it does sit much lower than the information technology at 23.8. But remember, we don't jump to any conclusions until we hit that valuation. Now, we are starting to see a lot more of that inconsistency of the overall industry, because when we look at the free cash flow payout, we do get negative in 2023, which ultimately does show us that the free cash flow per share has been negative in that more recent year, and overall you do get that cyclical nature of the industry, which you could argue we didn't see in the first few companies. Whether or not that is a factor in your investment decision, that is something that will have to come from your overall investment thesis. We then also see the sales growth. In fact, when we do look at it from the broadness, 5 of the last 10 years have been negative, including 2023 with a 49% drawdown, and we do note 16 billion in 2014, 15 in 2023. Then when we look at these shares outstanding, as always, it is important for us when we do want to talk about companies returning cash to investors that not just the dividend growth is seen, but also the shares outstanding reducing, so those share buybacks taking place. We do see that over the longer term, although it is a very small amount, and in fact during the period as well, they have also diluted your position as a shareholder. Then we get to the ROIC. Remember, above 12% is what we want to see. We saw that in 2022, however in the more recent year, negative 9%. Not great. Ultimately does mean they did turn a loss, as we are about to see from their margins. In fact, in 2023, the operating margin, negative 35%, is a little bit cause for concern. We have seen the share price drop, in fact, as we have taken a look from the all-time highs. But ultimately, this will take place when we do look at the margin of safety, whether or not right now it is sufficient for us to execute on. And we can also note here the inconsistency from the free cash flow. Now, net debt to EBITDA, very high in 2023. That is why we do get that borderline safe score of 2.05. Positive to take is if they can execute on this over the next 12 months, it is anticipated to reduce to around 0.31. So let's look at the valuation. Now we get $138, very, very similar in fact to the previous company Broadcom. Wall Street do believe that their value is much higher over the next year. They see 90% upside. That is a significant amount and will ultimately be the highest that we do see today. In terms of MOS, well, 10% we see a buy up to 124, at 20% around 111. At the 30% point, we do in fact note still a buy around $97. And for those that want a 35% MOS, that is a buy up to around the $90 mark. As always though, do give us your thoughts, and maybe with a 35% MOS and Wall Street incredibly bullish, we in fact saw Quant also giving this a strong buy. This could be one that you do believe is something that you should take for more further consideration for your portfolio. As always though, do give us your thoughts below. We then take a look at Lam Research Corporation, one we have reviewed before that does look good for a further in-depth analysis. We have a double buy rating from Seeking Alpha and Wall Street, a hold from Quant. We do note it is trading in the lower end of the 52-week range with a yield around 1.2% and a forward P that sits below the S&P at 21.4. Over the last year, it is up only 9%, so has lagged behind the industry as a whole. Over the last 5 days, down around 5%. And if you've been a long-term shareholder, well, very, very good, up 970%. Now, in terms of their earnings, well, they have in fact outperformed analyst targets 100% over the last 4 quarters. And moving forwards over the next 4, they are anticipating double-digit EPS growth. And as we can see, and as we have gone through, the forward P coming to 16.64 in June 2026, again on the assumption they do hit their EPS estimate. In terms of dividend safety, well, a 66 score, so that does look to be safe. And market cap, again, one of the smallest ones we're looking at today in line with Micron Technology, 99.4 billion. Now, in terms of looking at the last recession, well, they had no dividend, so no comparative data. They had below average growth at negative 55%, and they also marginally underperformed the S&P, negative 64. Dividend growth, though, looking very good. In fact, just last month, we saw a double-digit increase, 13 over the last 5 and 46 over the last 10 years. A very good dividend growth company, and they've been increasing those dividends since they paid out 10 years ago. In terms of dividend yield theory, well, we do in fact note a reasonable valuation, both based on the yield as well as on the forward P, not too far off. And we do note it is marginally lower than in fact the information technology sector as a whole. In terms of free cash flow payout, good thing is here that it is below the 50% every single year. No surprises why we get that lovely double-digit growth. Free cash flow per share as well, it has been increasing very dramatically, in fact, from 2015, nearly 10 times growth, although we do note a very smaller growth anticipated over the next 12. And when we look at the sales growth, again, we do note that cyclicality. Unfortunately, the more recent year is down around 14%, and that is reflected in the share price when we do compare the growth of this company against semiconductors in the space over the last 12 months. From a numerical standpoint as well, we do see their top line up around 3 times over the last 10 years, as well as those share buybacks taking place. Again, they have issued shares, but overall the net position has been a very, very nice share buyback for those investors. Then we get to ROIC, no worries whatsoever, above the 12% pretty much the majority of the years. Last 4 years looking very strong as well, something we have noted from this industry. ROIC, particularly over the last few years, looking very good, and a well above 16%, and the operating efficiency, something we always like to mention that is very important whether you're looking at this company or not, that the companies you consider do show us that they are high quality, increasing top line as well as increasing margins. Free cash flow as well, looking very, very strong. Then we get to the net debt to EBITDA, nearly as good as Nvidia and ASML, nearly zero right across the board, but then nonetheless, that is what we see in 24 as well as the next 12 months. Now, getting into the valuation, our intrinsic value pretty much in line with Wall Street, who see 44% upside, and when we run it through the MOS calculation, 10% a buy at 978, when we put 20% a buy at 870, at the 25% mark around 815. In fact, in today's episode, it is a very large MOS, pretty much at the 30% level at 761, 762. So it could be a good one to consider if you do want some exposure outside of the big names like Nvidia, ASML, and Broadcom. And as we mentioned, Wall Street, very, very nice upside at 44%. We then bring us onto Qualcomm, where we have a double buy and a hold from Quant. This one is trading in the mid, moving towards the lower end of the 52-week range. The highest yield on offer today, just over 2%, and a very healthy forward P of around 16. Over the last year, up around 45%. Over the last week, in fact, one of the smallest losers, only down around 3% in comparison to the others we have reviewed today. Over the last 10 years, up around 117. Now, in terms of the earnings, we do note, again, very consistent theme today, beat 100% track record, and we see some very nice growth anticipated over the next 4, bringing that forward P down to around 14.5 in September 2025. Now we see a very healthy 80 dividend safety score, market cap at 182 billion, a mega cap company. And we also note when we do look at the last recession, they did increase the dividend, they had above average growth, and they massively outperformed the S&P, negative 21, remember the S&P, negative 55. Dividend growth as well, nothing to write home about, 6% in March this year, 5% over the last 5 years, but over the last 20 years, we have seen a very strong, very healthy 20%. So we do in fact note they have been increasing those dividends for the last 20 years. And remember, if they hit 25 years, they will become a dividend aristocrat. We then take a look on the dividend yield theory. You could argue reasonable valuation, yield not far off the 5-year, as well as the same to go for the forward P, although we do note it is much, much lower than the information technology as a whole. Then when we talk about the payout ratio, what we do note here is in fact, whilst we want to see below 50%, that hasn't been the case every year, but it has been over the last 3 as well as the next 12 months. And when we take a look at the free cash flow per share, whilst we do see the cyclicality nature come through the numbers, it has nonetheless doubled over the last 10 and expected some strong growth over the next 12 months. Then we look at the sales growth, again another company where the cyclicality shines through the numbers. 5 of the last 10 years have been negative, including the more recent 2023. And when we do look at it in terms of the numbers increasing, 26.5 in 2014, 36 in 2023. They have been one of the best ones in today's episode in terms of returning excess cash, bringing down that share outstanding numbers quite significantly and quite sharply over the period, with the ROIC again looking very healthy, well above the minimums 12% for the majority of the last 10 years. Again, the last 5 to 6 years looking very strong. And ultimately, we do on this channel like to pay a little bit of a premium for those that do give us that consistency. Margins looking good whilst we don't get operating efficiency, still above the minimums we want to see, and the same to go for the free cash flow. Inconsistency has been a bit of a question with this company, but overall the numbers do look very, very healthy from a generalization over the last 10-year period. And we do also see the net debt to EBITDA has been coming down from the highs of 2018 to 2019, 0.35 in 23, 0.1 over the next 12 months. Very strong balance sheet, and no surprises why that dividend does look to be safe. Our intrinsic value has stayed similar as well, around $210. Wall Street marginally higher, 221, upside of 36%. And when we do run it through the MOS calculation, well, 10% a buy at 189, at 15% around 178. And in today's episode, you are getting at least a 20% up to around 167, 168. For the 25% mark, you would have to wait for 157, so somewhere between 20 to 25%, with Wall Street giving this a 36% upside indication. Now, one thing we want to do before we do end the episode is just talk about a semiconductor ETF that we like quite a lot. It is SOXQ. Now, why we prefer this to some of the others, the first thing that we do want to note is essentially it has one of the lowest expense ratios when you do compare it to some very popular names like SMH, like SOXX, and we do also get a double buy rating seeking out front quant. It trades around the midpoint of the 52-week range. You do get a yield of around 0.72%, and over the last year, it is up still after the pullback around 29%. As we can see, over the last 5 days, it is down around 6%. When we look at the top 10 holdings, the first one is Nvidia, around 13%. When you look at some of the other more popular ones like SMH, you will note that whilst Nvidia is still the top holding, the exposure is a lot more, so something just to highlight. And in fact, quite a number of those that we have covered today sit within their top 10 holdings. We have Nvidia, we have Broadcom, we have in fact ASML as well. And the final thing to note is over the last year, when we do compare it in terms of others, we are talking about in a very similar size. We have this as the number one, up 30.42%. And as we just mentioned as well, in terms of that expense ratio, which is always very important to note, it is the lowest at 0.19. You in fact do get some that sit here at 0.6%, just something to bear in mind. As always though, if you did enjoy today's episode, value was provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to click on the pinned comment below so you can sign up to the free weekly newsletter, grab yourself those 25 undervalued stocks for the month of September, and also come and join us in the Patreon below if you do want to discuss our weekly buys and sells. As always, have a great day and we'll see you all on the next one.